Today there was a bumper expiry, guys. The market opened with a gap up. I have been observing the market, but due to some problems, my Telegram channel got hacked. Otherwise, I would have updated on the Telegram channel. Was busy with some work, so could not come on live. But if you guys had been observing the news, the analyst and all of the other participants, I believe a few brokers also had recommended that today would be some positivity would be there because the Fed did go through the announcement and it did not look that negative, although Nasdaq, S&P and everything opened, closed at a positive. But still, this you have to understand that the market won't go up if there is slight positive news. And in this scenario, the best trade which you could have taken is the downwards. When today market opened with a huge gap, first of all, I would like to tell you that there is one strategy in expiry. Whenever the market tends to make a gap up or a gap down, usually the market tries to fill in the gap during expiry, and I have seen that. Why, you may ask? Because during expiry the market is highly volatile and there is a lot of uncertainty in the market. And second of all, you will see that most of the times there is a bumper movement during expiry, especially the downside. I really like this because if you're buying a put option at 100 rupees, which is in the money, you can easily sell it for 500, 1000, even 2000 rupees, guys. And this is common in bank nifty. I've always seen it. Today, if you would have bought the put option, I'm talking about newbie traders and people who have been buying options, they have a bad experience. And usually what happens, the chances of a put reaching to 900 is actually lower than that of it reaching to 0. So if you are new, I would recommend sell options but wait for the target, because if you would have sold the call option, you could have waited. But if you would have bought the put option, I don't think that you would have waited till the price reaches 700, 800, and that's speaking too much. 700, 800 is too much. Maybe you would have waited till 400, which is 1 is to 4 times, which is good, okay, no doubt about it. But still, I doubted that even people would have been able to wait till that long. And if you are an option buyer, if you are wanting to make profit out of this market, then you have to follow the risk to reward ratio. You can't exit from your position seeing 50 point, 60 point profit, whether you are trading with one lot, two lots, or whether you're trading with 1000 quantities. And when you're trading with 1000 quantities, it becomes absolutely important to maintain the risk to reward ratio, unless you're doing some scalping shit and you know that there are good support or good resistance at a point and you can buy from there. So that's why we have to maintain a good risk reward ratio. Now, if you are an option seller, sell with small quantities, and I believe lots of traders have made good amount of money, because when you're selling, especially during expiry, you have an edge over the buyers. If you have shorted the call, say about 500 rupees, which is at the money call, then you could have waited till the end of the day, because if the market comes down, fills the gap, and then does some time pass and goes up a bit, and then it closes near about the gap, you would still be making more than 300 points. But again, you can't exit from there, because buying a call option and buying a put option and selling a call option has a huge difference. Buying a put option can give you unlimited profit theoretically, but this is not possible, guys. We have never seen an unlimited profit in options. We have only seen the profit ranges to about 1000. I have seen maximum that 40, no, 30 rupee put option have gone from 40 rupees to more than 800 rupees. That's the maximum which I have seen. So maybe 1000 rupees, say 1000 rupees, that would be the maximum which you can gain by buying options, and that's a lot. That's almost 1:10, but you will have to wait. And the way you can wait till your target is by exiting half of the quantity. So that's what I like to follow this time. Take 50 quantities, okay, 25 you exit at 120, 130, whatever your target may be according to your risk to reward and the strike price which you have chosen. Minimum take 100 points and then wait for the rest. If the put option gives 1,000 points, then you will take 1,000 points, but you won't be able to take the entire 1,000 points, because obviously it'll go to 1,000 and then maybe it'll close at 800, just like today. But if you are an option seller, you don't have the advantage of getting a risk to reward ratio of 1:10. You'll have to sell it at 500, and maybe you can eat the premium. Say you can eat maybe 400 points, but the advantage is that even if there's a volatile market, at times what happens is that we buy the put at 40 rupees or 50 rupees. For example, today if you would have bought the put at 40 rupees, it would have gone to 100 rupees, and suddenly there was a reversal, and during that reversal the time decay had accelerated so much that that 100 rupees, the profit which you were saying, was virtually gone. It went from 100 rupees to, I believe, yeah, I believe it went from 100 to 60 within seconds. So when you see that much amount of volatility and your profit getting wiped off, you tend to square off at 60 rupees, near about cost, and then later on you see that that same option has gone to 800. This has happened to so many people, I know that, guys. But in this scenario you will have to wait, because you are an option buyer, and remember, this risk to reward ratio is important for option buyers and option sellers, especially for option buyers, because during expiry there will be times when the options will go to zero and you will not be making any amount of money. But there will be times when the options will give you a bumper profit, and if you don't take that profit during those days, then you won't be able to come at a profit, or maybe be a break-even trader also. So I hope I have covered all the points. You can take the gap filling strategy during expiry, and it has an expectancy, or it has a profitability ratio of more than 80% of the times according to my research. And the only thing which you need to be careful about is you have to take the option which is in the money, and take the if you are a seller, then sell at the money or near at the money, so that you can get a good amount of points. Okay, I hope you have enjoyed this. I know people are saying that today, if I would have uh, if you would have invested 1 cr in the options, it would be 12 cr, right? But trust me, guys, you would not be able to hold it. Forget about 1 cr. Even if you would have invested 10,000 rupees in the option put option today in the morning, seeing the gap, you would have squared off your position after, right after it had filled up the gap. I promise you that. So this will only come with discipline. This will only come with you exiting half of the quantity and then waiting for the rest. Okay, I hope you enjoyed this video. Definitely give it a like, and I'll share more strategies in the future. Bye.